You are most welcome. And thank you again for
Thank
being
you,
with us
Francois.
in Paris. In Paris, you cherish, I should stress it again.
Yes, and I'm sorry not to be able to join you, as you know, in person there today. So I would just begin by thanking you for inviting me to take part, and also by agreeing with what the take that Augustine articulated. To begin with your last question, I do think that the monetary policy normalization that we're seeing all over the world, all it did was simply reveal what we've long pointed out as significant structural issues in the DeFi ecosystem and conflict of interest. And all of those things have been revealed, in effect, as the tide has gone out. So I don't think that's a particularly important part of the question here. Really, the question is that within the DeFi ecosystem, there are these very significant structural issues around transparency, lack of transparency, and I think Augustine did a nice job talking about them. So the good news, I suppose, is that the interaction between, from a financial stability standpoint, the interaction between the DeFi ecosystem and the traditional banking system and traditional financial system is not that large at this point. So we were able to witness the DeFi winter, but it didn't have significant effects on the banking system and broader financial stability. And that's a good thing. And I think it demonstrates the weaknesses and the work that needs to be done around regulation carefully and thoughtfully, and gives us a little bit of time. That situation will not persist indefinitely. Ultimately, that's not a stable equilibrium, and we need to be very careful about, and I guess we'll get to this a little later, but we need to be very careful about how crypto activities are taken within the regulatory perimeter. In any case, wherever they take place, as Augustine pointed out, there's a real need for more appropriate regulation, so that as DeFi expands and starts to touch more and more retail customers and that sort of thing, so that appropriate regulation is in place.
Come back to regulation in our second part. Ravi, can I ask you a brief reaction also on this financial stability issue?
Yes, well, thank you, Francois, and thanks for the invitation to participate in this, and greetings to my colleagues, Augustine, Christine, Jay, good to see you. I generally agree with what Augustine and Jay have said. Let me add a couple of nuances. I would say it will be useful to distinguish the various components of what we call the crypto ecosystem. And I think the kinds of risks each of them pose and the kinds of benefits each of them pose and what they mean for financial stability would be quite different. So if you look at, say, tokenized assets, for instance, there are many banks experimenting with this. Basically, you express the ownership rights over an asset as a digital token, and cash and bonds, real assets, intangibles, carbon credits have all been tokenized. These in and of itself, I think, pose lesser risk, but they're not the predominant part of the ecosystem, unfortunately, although I think that's where the real potential lies. Then you have cryptocurrencies, for which I don't see any redeeming value, because they're meant to be used as a medium of exchange within the distributed ledger, but we have all seen how they've taken a life of their own outside and are posing a range of risks, some of which Augustine have spoken about, ranging from consumer protection, volatility in value, money laundering risks, and even financial stability risks if pushed to the extreme. And the speculation in these currencies has led to price changes that are nothing to do with the underlying economic value. And I think with the current monetary policy normalization process and tightening, it is, as Jay said, they're going to expose the excessive exuberance that has been attached to these cryptocurrencies. And I think they're going to be affected badly. In fact, all of us on this panel, I think in our own ways have been saying this, the risks involved in investing in cryptocurrencies, but who listens to central bankers, right? And I'm afraid it's the time for reckoning has come. I'm a little bit more positive about stable coins if they're done well. Basically, these are digital tokens whose value is pegged to another asset. They can have a good potential as a medium of exchange because they're digital cash, they're programmable, can be put on the ledger, provided their value is fully backed by reserve assets. So the focus of regulation is quite different in stablecoins. If we can crack that problem through an appropriate regulatory regime, I see more promise for stablecoins, and almost by definition, they should, reflect the demand for underlying fiat currencies to which they are pegged. And so the impact of interest rates and all that will be really reflecting the underlying assets. So I think we need to make distinctions across the three. And DeFi is a totally different animal. All these things that we discussed in the crypto world can operate alongside the traditional financial system. In fact, many banks and traditional players are involved in these innovations. DeFi is a totally different thing. And I fully agree with Augustine, there is a lot of stuff that's unknown. I would just say the central problem is that even if you can address the other risks, the big risk is where are you going to apply the regulation to? Because all our regulatory approaches are based on applying regulations to legal entities. In a decentralized world, you can't do that to an algorithm. And pinning that governance and risk management responsibility on the players that can make a difference in the DeFi world is exceedingly difficult. And that's something, if we can overcome, I can see some promise in DeFi. Otherwise, this could be a game stopper. But I want to say that you don't have to go as far as DeFi. Crypto assets and digital assets have a role to play alongside traditional finance. Some of them are working, some of them not going to work. And I think the current normalization phase in monetary policy is going to expose which are the ones that are promising and which are the ones that are purely speculative. Thanks.
Thank you, Ravi. And I'm sure the distinction you made between different animals will be useful when we will discuss more precisely regulation, as Jay mentioned. By the way, you use the word cryptocurrencies sometime, and usually we central bankers don't like that much the expression cryptocurrencies because these are not currencies, these are crypto assets. But I'm sure we agree. Christine, do you want at this stage to intervene and react, or do you prefer to focus on central bank response in the second part? Please, you are very welcome. Bonjour.
Yeah. Thank you so much. Bonjour, François. And thank you so much for having us. And I think it's very fitting, actually, that we discuss this enigmatic phenomenon that took the world in such a stormy way, right in the middle of the museum in the world that keeps probably the most enigmatic painting, Mona Lisa. So thank you for having us in the Louvre. It's just perfect. So just 3 points that I wanted to share with you, which I keep thinking of in relation to crypto assets in general and the impact it has had. First of all, the evolution has been stormy. It went from this sort of cultural hype pushed by libertarians, promoted by Satoshi Nakamoto in his wisdom and total anonymity, to being this tool that is now accepted by the PayPal, Visa, and MasterCard of this world, and which has been abused by whether it was Terra or Luna, but certainly Mr. Do Kwon, who is on the run, is the other side of that enigmatic coin, which warrants the regulation that has been advocated by both Jay and Ravi. Second, where evolution has been critically important is this search for yield, which has clearly encouraged and accelerated the process at times when across the world we were in the lower bound and where interests to be earned were limited. And third, the world was caught by surprise. And from these regular statements that we all made that, oh, of course it was growing, but it wasn't systemic. Well, we are now at a stage where between 10 and 15% of Europeans and Americans actually have invested in cryptos in 21. And where clearly regulators, consumer protection agencies, supervisors are now really attentive to developments. So those are three interesting aspects: this cultural evolution, the search for yield, and the world caught by surprise that I associate with the development of cryptos, that I will go into further details in the second part of this session. Francois, thank you.
Very much to the four of you. By the way, a technical remark, there was some echo. I wonder if each of you can be on mute when you don't speak, but we could hear quite well. So we come to the second part about the responses by central banks to this landscape you presented to us, Agustin. Obviously, it calls into question an almost philosophical point, the relation along history between public and private money. And as all of you have said, it's a question of combining regulation and or innovation in our responses. So as I said, I suggest that our two prominent central bankers across the Atlantic, first Christine and then Jay, focus on their view on the topic. My understanding, and I say it with a smile, that Christine, you intend to focus perhaps a bit more on innovation and CBDC, and Jay, you intend perhaps to focus a bit more on regulation. Perhaps people would have expected the US central banker to focus on innovation and the European one to focus on regulation, but at least it shows you that we are all on the same page of combining both. And Christine, if you agree, you start.
Okay, well, thank you so much, Francois. And very briefly, by way of introduction, the way it was, the disruption, and what we need to do, we central bankers, to stay ahead of the curve and be in the game. So the way it was and the way it is, in a way, is what you just alluded to, Francois. It's this combination of public and private money, public money being the matter for central banks, either cash for individuals or central bank deposits for banks, and private money, where commercial banks were the main player, making up around 85% of M1, and being innovative with new forms of payment, from giro payments to cards to any other things. And both of those, public and private money, actually complemented each other quite nicely. Then came the disruptors, and I could not agree more with Ravi about the distinction that we have to make when we analyze the way forward and the regulatory framework, where we have to distinguish between the crypto assets, the traditional Bitcoins, Ether of this world, and the stable coins. And where I totally agree with Ravi that the crypto assets, not currencies, but the crypto assets are obviously pure speculative assets. And I think that the movement that we have seen in the last 12 months is clear indication of the fact that it is indeed a speculative assets, and certainly not a means of payment, not a very stable store of value. That's one aspect. The second aspect, which is more promising, and I also agree with Ravi on that, is the whole sector of the stable coins, which only represent about 10% of the entire crypto universe. So it's very minimal for the moment, but it is promising as long as we don't have players that abuse the system, that pretend that they have liquid assets to back their stable coins, or that it's one for one, when in fact it is not one for one, and Terra is followed by Luna bankruptcy. So that is possibly disruptive, but it is, for the moment, as I said, only 10% of this crypto universe that we are talking about. But it has created, and it has probably accelerated, the desire for more innovative ways of paying, more innovative ways of transacting. And as a result, digital payments are clearly in high demand. And this is more so in some countries, less so in others. Just to give you an example from Europe, in Sweden, for instance, there is virtually no cash transactions anymore because cash is not there. Whereas currently in Austria, there is a referendum to defeat a proposed regulation to request that payments be not in cash above 10,000 euros. Well, in Austria, they would like to be able to continue to pay more than 10,000 payments in cash. So there is great heterogeneity in the request, but we can see in the surveys that we have conducted that there is clearly an aspiration, a desire for digital payments, much more so than it was in the past, and this is growing. We are now, in the surveys that we've conducted across the 19 members of the euro area, we have more than 50% of the respondents who say, we want digital payments. Well, less use of cash, demand for secure and riskless payments. Where do we stand? We central bankers, we have been operating as a monetary anchor in relation to the commercial banks and the private money. If we are not in that game, if we are not involved in experimenting, in innovating in terms of digital central bank money, we risk losing the role of anchor that we have played for many, many decades. And we have historical examples of period where the central bank monetary anchor was not there, and that precipitated crisis after crisis. That certainly was the case at the time of the free banking in the 19th century. Do we want to go back to those days? Probably not. I would say certainly not from our vantage point, as a result of which we have to respond to the demand for those digital payments in order to maintain the role of anchor that we have been playing regularly. So what have we done here in Europe and with the whole euro system, including all the central banks that are members, including notably the Banque de France, which has been very active, but also Banca d'Italia, Bundesbank, and a few others, but certainly all around the ECB. We have decided early on to start experimenting discreetly and try to understand the concept, the preferences, the media that could be used, and the characteristics that should be presented by the digital euro, as we call it. We're not the only one. Back when I started as president of the ECB, there were about 30 central banks that were looking at it. As we speak now, and I have nothing to do with it, the BIS, I think, has done an inventory of who is doing what in the zoo, and there's more than 100 central banks that are currently looking at CBDCs and exploring what characteristics it should have. So for us, it's the digital euro project. We will decide in about a year's time whether we actually move into a additional phase and prepare the post-prototype phase. We are now currently in the prototype phase, and we're certainly not ahead of the game because PBOC in China is ahead of us and a few others, but we are not doing badly in terms of timetable, and we are sticking to it. What I would like to do, François, is just very briefly go through the characteristics that we see as important. First of all, it has to be a convenient medium of exchange, that it becomes part of everyday's life for the Europeans. Number two, and why is that? Because customers, Europeans who have been surveyed, have indicated that they want to be able to pay anywhere and expect instant, easy, and contactless payment, especially person-to-person payments. Second, it has to be a success. It is not a venture that you can go lukewarm. You have to be 100% sure that it will actually work. You cannot fail on that one. There are pitfalls, obviously, and if a digital euro is overused, for instance, as a form of investment, it could crowd out commercial bank deposits and affect credit intermediation in the economy. So while we talk about DeFi, which is disintermediation essentially, and finance determined by protocol, the way we are thinking about it includes actually intermediaries and makes sure that commercial banks are part of the system. We also believe that there should be well-designed safeguards that either would include limitations to the holdings or would include a sophisticated tiering system in terms of remuneration in order to prevent that the digital euro become a very attractive investment more than a mean of payment. We want appropriate pricing and distribution via payment service providers, because as I said, it's not something that would be done in abstracto without the intermediation of the commercial banks or other private parties, actually. But certainly the pricing should be right. And all of that is intended for the retail segment of the digital euro, which doesn't mean to say that it would exclude, quite to the contrary, actually, a wholesale settlement infrastructures that is often referred to as the wholesale CBDCs. Actually, that in a way exists already, although in maybe a preliminary and not sophisticated enough form, but certainly the wholesale CBDC must be explored, must be part and parcel of the overall system. And I know this is something that, Francois, you feel strongly about, as I do. And the settlement infrastructure on which we operate, which has a dimension of digital about it, needs to be significantly upgraded and needs to be made more digital than it is at the moment. And in that respect, if the counterparties, if the commercial banks with which we operate expect distributed ledger technology to be part of the improved infrastructure payment, then we should certainly be open to it and be prepared to endorse the digital ledger technology as part of this improved infrastructure mechanism. So well advanced on our way and moving into, as I said, prototype phase that would precede the decision by the Governing Council to effectively move ahead with the project. Thank you, Francois.
Thank you very much, Christine, for sharing with us in such an open and clear way your thoughts and questions on CBDC, including how to work with intermediaries. And I'm sure it's of great interest for the participants in the conference. Jay, can I now turn to you? And you insisted rightly on the importance of regulation. I know that the Fed's research and reflection on stable coins, for instance, is of utmost interest. Jay, I only add that I cannot resist the temptation to invite you at the end, if you are ready, to say some words about CBDC also seen from the other side of the Atlantic, but up to you.
Thank you, Francois. And you've also given me a perfect opportunity to point out that we have a long and proud history, actually, on working alongside the private sector in support of responsible innovation that encourages efficiency, lowers costs, and brings better products to the public. We do favor responsible innovation, including in crypto-related services or products. I think back to the times when checks kind of became obsolete in a lot of ways, and we were very much in the middle of fostering that transition. The Fed is also roughly a year away from rolling out FedNow, which is an instant payment system that will make instant real-time payments available to the public through their banks. So the whole point of regulation, of course, is to create a level playing field that will allow us to reap the benefits of true innovation while avoiding the pitfalls of regulatory evasion. So turning to regulation, I guess I'll make a couple of higher level points about the regulatory challenge that we all face, and then talk a little bit more about stable coins, which I agree are to be thought of as quite different from unbacked crypto assets. So I guess the fundamental principle for all of us, I guess, is same risk, same regulation. Some of these crypto activities resemble traditional financial activities. And they need that. They need same risk, same regulation wherever they take place. There are also some novel activities, though, genuinely novel, that are really a paradigm shift. For example, replacing intermediaries with smart contracts or decentralized governance and control structures. And so these novel structures create potential new risks. And I think we have a lot of work to do on that. We've got a lot of work to do across both the more traditional looking parts of DeFi, but especially for the novel aspects of it. An example would be unhosted wallets, for example, which allow users to custody their own crypto assets. However, they can also be used to evade sanctions or engage in money laundering. And there are other novel aspects of it that are quite challenging. Not least, as I guess two of my colleagues have pointed out, the fact that this is a borderless world, and just we look to regulate an entity. And as I think Ravi pointed out, if that entity is an algorithm, how do we do that? So there's a lot of work and a lot of thinking to do to determine what practices are acceptable, which ones are flawed and predatory, what can be done to address these problems. This is new technology. It certainly has the possibility to bring improvements and efficiencies to the financial system. We've got to realize, though, that in some cases, these apparent efficiencies are really superficial in the sense that the cost saving comes from ignoring risks or failing to maintain appropriate levels of assets and liquidity to deal with those risks in good time and bad, and from complying with laws. So those are some higher level points. On stable coins in particular, so as I think others have pointed out, most of the usage of stable coins now is on the crypto platforms. In effect, stable coins are a money-like asset that is used to settle transactions on DeFi platforms. But many stablecoin issuers are talking about it, and there's a great deal of interest, I think, everywhere among potential stablecoin issuers to reach the general public more broadly, including retail payments and that sort of thing. And I think so. That's really what our main focus here, from a regulatory standpoint, is should stablecoins be used in that way, much more broadly, much more public-facing, away from the crypto platforms? What's the appropriate regulatory structure? And we have a group of U.S. regulatory agencies under the leadership of the Treasury Department put together a proposal or an analysis and a proposal, and we encourage Congress to pass legislation, which we think is needed for this kind of stablecoins. I'm happy to say that the House Financial Services Committee here in the United States is working on a bipartisan bill. And that's a very constructive enterprise. I will say that from the standpoint of the Fed, the central bank, we think that the central bank is and will always be the main source of trust behind money. Stable coins essentially borrow that trust from the underlying issuer, and in many cases these are dollar stable coins, so they're really borrowing that trust. These are private forms of money. They will be subject to runs if the assets, if their reserves are not full of very high quality assets. So there's a regulatory job to be done there. We also think if you're going to have private money created across the country, really there needs to be a federal role. I would liken it to what happens with the dual banking system here, where there's a very important role for state regulators, but there's also a role for any commercial bank in the United States. There's also a role in licensing that bank to operate at the Fed or another federal agency. And in the case of this, which is money creation, we think it really should be the Fed that does play that role. So that's our principal focus now, I would say. Turning to your question, so cash is not disappearing here in the United States. We still use cash quite a lot. It is declining, not in absolute terms, but compared to non-cash payments, it's declining. And we're motivated by really what Christine was saying, to look very carefully at the potential costs and benefits of issuing a central bank digital currency here in the United States. So we agree that the central bank has always provided the stable, trusted anchor for the currency. That's really perhaps our most fundamental role as central banks, one of the most fundamental roles anyway. So we're looking at it very carefully. We're evaluating both the policy issues and the technology issues, and we're doing that with a very broad scope. We have not decided to proceed, and we don't see ourselves as making that decision for some time. We see ourselves as working in collaboration with both Congress, of course, but also with the executive branch, which brings expertise to many of the issues that we have to deal with here. And at the end of the day, we will need approval from both the executive branch and Congress to move ahead with a central bank digital currency. So we see this as a process of at least a couple of years where we're doing work and building public confidence in our analysis and in our ultimate conclusions, which, as I say, we certainly haven't reached yet. I guess I would just say that's where we are. We've got a lot of work to do. There are many more things to say, Francois, but I'll stop there.
comments, in my view, about central bank money, trust, and stable coins were very enlightening. Do you allow me one further question, Jay? Listening to you, I was thinking that perhaps dollar-based stable coins are not that different from MMF, money market funds. Would you agree with this parallel? And could it mean that their regulation should not be that different from the regulation of MMF?
I think, Francois, that's a very reasonable observation. If you think about, and these are not, again, these are not the stable coins that are being used on the crypto platforms. This is a world in which stable coins are being offered more to the general public. So they have aspects of bank deposits. You could say they have aspects of money market funds. And of course, both of those are very substantially regulated, and appropriately so, because the general public will look at, I think we know from our experience over time, they'll look at a form of private money like that, and they'll assume that it's money, that it's money good, that it has the central bank's backing, or something like that, so that they can trust it. And we just need to make sure that if the public is going to be facing and dealing with stable coins that carry that implication, that the reality is there. And I guess Ravi mentioned the reserves. The reserves need to be transparent, publicly, transparent to the public, and they need to consist of the kind of, credit assets that will always be there when there's a need to fund withdrawals, because otherwise the structure will be run-proof. And we saw that in the last few months in a couple of cases where stablecoins were not able to handle the withdrawals. And we saw it regularly with money market funds in the last two financial crises. In both of those cases, some of the money market funds were not able to, or really struggled to keep up, and the Fed had to step in and provide liquidity to that part of the market. So again, that's another form of private money, and we think it needs appropriate regulation.
Thank you. I now turn back to our two panelists, first Ravi and then Agustin, with at least two questions, but you are free as long as you remain brief, but you will be. First, about the regulation of the various animals, Ravi, you mentioned, including stable coins, looking at what Jay just said. And second, on the innovation side and CBDC, how do you see the respective importance of retail/wholesale CBDC? Because this is a debate Christine touched upon, but which, in my guess, could be rising in the next years. Ravi first.
Thanks, thanks, Francois. Let me try to address those questions in three buckets. The first bucket goes back to a point that you raised earlier between public and private money. So I want to first say, what is it about the crypto phenomenon that has changed that thinking? I mean, right now, most of our money is private money. It's called commercial bank deposits. And it works because it is anchored on public money, central bank issued money, the monetary base. And there are a few things that give this confidence and anchorage. One, regulation and supervision, capital requirements that protects the asset side of the balance sheet of banks, liquidity ratios, and a whole range of prudential things that prevent or try to minimize risk to banks. Second, the central bank stands as lender of last resort. That is what gives private money or bank deposits confidence. Third, deposit insurance. It covers most bank deposits up to a high level. So this is the anchorage that we currently have that allows private money to flourish and people have confidence. What is lacking here? This money is not programmable. This money cannot be put on a distributed ledger to carry out some of the use cases that Christine spoke about, particularly cross-border payment and settlement. You can't have atomic settlement or the mutual exchange of two assets in real time with existing platforms. You need a distributed ledger. You need money that is programmable. That's why there's demand for crypto or digital cash. Now, then there are four contenders for digital cash. First is CBDCs, which you raised. Central bank itself issues the digital cash. Second, you have stable coins. Private sector issues digital cash, but is pegged to a fiat currency. And our role is to make sure that peg is solid. Third is tokenized deposits. We haven't spoken about it. Existing bank deposits, a part of it could be tokenized and put on the ledger to carry out all these use cases and benefits. And the same protection that the banks have will apply to these in theory, at least. And that's something we regulators need to think about.
This is what about tokenization. Perhaps if you agree, Agustin, could you take the floor? Ravi, you have you back
so
in Paris, which is good news.
Coins, and
can I ask the technicians to try to settle the issue? And Agustin, if you are ready to react on this question of can we have a call with Singapore and check how it works? Ravi, we will come back to you if you can listen to me, because we have a slight technical problem. Agustin will intervene and you will be back. Okay?
Okay.
I think that there are many dimensions. One that we need to work it out is the coordination to try to tackle the issue of borderless crypto and in a way like lack of the ability to identify which entities are doing what. Now, given said that, I think that we should not completely sacrifice to think about regulation both through have activity-based regulation and entity-based regulation. There are many entities in a DeFi, in the crypto world, that can be identified. For example, who establishes the rules of the algorithms? Who takes the decisions about stable coins? Those are centralized entities. As a matter of fact, what we have said in the BIS, there is an illusion of the decentralization. At the end of the day, there are quite well identified central players that can be regulated, and I think we should move in that direction. I also think that we should have the ability to question the universal application of same activity, same risk, same regulation. For example, a repo done for DeFi purposes by an exchange that doesn't have limits on capitalization, doesn't have liquidity rules, doesn't have leverage rules. They can do repo ad infinitum, without supervision of the collateral that is involved in a repo. Is a repo done in the DeFi context the same as a repo done in the banking system? For me, it's a very different animal. Therefore, I think we should have that flexibility. So big challenges there, and I think they're very, very important. And as a matter of fact, I fully support the view that Christine mentioned at the beginning, at the outset of her intervention. Search for yield, the blow of search for yield was a huge contributor, not the only one, as I said, for the deflation of the crypto world, but had to do a lot with the quasi-Ponzi scheme that was going on because of lack of regulation and abuse of figures like repos. So I think we need to have that nimbleness to do all this. Now, in terms of CBDCs, I think what Jay and Christine has said is precise. I don't have much to add, but I would build a little bit more in the direction of where Ravi was going, and that is, I think CBDC can really become programmable and can facilitate the incorporation into more traditional type of transactions of many of the ideas behind DeFi, like programmability and so on and so forth. So I think that the nimbleness that, for example, stable coins bring to the table should be provided by CBDC. And as a matter of fact, it shouldn't be that difficult. What does stablecoin mean? Stablecoin means it's a digital asset that doesn't have value in itself, and it has to import its value from trusted money issued by central banks. So, but if we have already trusted money, why do we need to export that value to another currency? Well, let's just present that money with the adequate technological representation that would allow for innovation and the evolution of the payment systems and the financial system in the way it is being pursued through DeFi.
And Agustin, I push the question on wholesale versus retail CBDC. If I was to be provocative, I would say that the BIS Innovation Hub, to my knowledge, is mainly focused on wholesale CBDC. Do you believe in retail CBDC? Yes or no?
I think it's a public choice. I think my basic point is it needs to prove its value. But one thing that we as central bankers, at least that's my opinion, personal opinion, cannot afford is if the public wants a central bank issued money for retail, we should be ready to provide it. I mean, if the society demands that, we should be able to provide it. I think we should do the work. If people do not want it, well, that's fine. But if people really want it, I think it behooves us to be ready.
Thank you. Ravi, we will turn back to Singapore. Sorry for this technical problem we have. By the way, I turn to the organizers. We will perhaps have 3 to 5 minutes at the end from 1 or 2 questions from the audience. So we will see if it's possible, but if you have questions, don't hesitate. Ravi, you are back.
Thanks, Francois. I'll just pick up from where Agustin left off. I'm a bigger fan of wholesale CBDCs than retail CBDCs. As I said earlier, the critical problems we're trying to solve can be solved by programmable money in the form of private stablecoins, tokenized deposits, or wholesale CBDCs. And I think the future landscape will have all three in play. And I think that's not a bad landscape, provided we can regulate stablecoins well, and the other two, will follow suit. Retail CBDCs, I think, is a public choice. It's not required to solve any specific problem of the kind we're discussing, whether it's trade finance, cross-border payment settlement, post and pre-trade capital market activities. You don't need retail CBDC for that. Wholesale CBDC, stable coins, and tokenized deposits can do it. So retail CBDC is a separate choice. I think it's a political economy choice and a public choice. A quick word on stablecoin regulation, which I think is where the crux of our focus ought to be. And Jay has highlighted the things that we're doing at the international community level. I think there are 3 issues we need to pay close attention. Jurisdictional differences in stablecoin regulation, I think, can be very challenging. The thing is this, the same stablecoin can be issued by several entities across multiple jurisdictions. So the same coin issued in the US and issued in Singapore could be subject to different standards. And this is and so we do need regulatory alignment, and this is something the international community is focused on. Then there are the decentralized governance issues with stablecoins that rely on algorithms. This is a huge problem, and we discussed that earlier on. And then third, there is systemic risks. Now, we say that stablecoins are backed by low-risk assets. Now, if they're fully backed by low-risk, high-quality assets, they can pose concentration risks. In times of stress, multiple stablecoin issuers can concurrently suffer from mass redemptions, leading to a fire sale of underlying financial assets, because these are a limited class of financial assets which we regulators would deem as low risk and high quality. So I think this is one risk we need to look at. So, but these are solvable problems, unlike the DeFi problems, which are almost conceptually difficult at this point in terms of regulatory technology to try to solve. I'll stop here. Thanks.
Thank you very much. I just check whether Christine or Jay would want to have a short reaction to what Agustin or Ravi said. Up to you. No? Up to you. Okay. Then if we can have a light on the audience and see whether there are some questions. I said for our free online panelists, we have a wonderful audience in Le Louvre, about 400 participants, but I'm just checking. No question? Apparently there is one question, but do you have a mic? Here? It will come. If you just are ready to introduce yourself and put your question briefly, thank you very much.
Bonjour, David Durouchou, Société Générale Forge. My question is related to the anonymity of the coins that we are dealing with. Cryptocurrency are bearing a lot of anonymity, and probably it is the reason why a lot of people are using them. Would CBDC bear the same anonymity, and how do you manage it in the future?
I hope the question was clear for everybody. By the way, you use the word cryptocurrencies, which was the best way to stimulate the 5 central bankers who are here. But I don't know who would jump on the question. And Jay?
Sure. I'll just say briefly, Francois, that we haven't made, as you know, decisions to proceed or not, but we issued a discussion paper in January of this year, and we said that we think that there are 4 characteristics of, if we were to pursue a CBDC, it would at a minimum have the following 4 characteristics. First is intermediated. Second is privacy protected. But third is identity verified. So it would not be anonymous. It would not be an anonymous bearer instrument. And fourth is transferable or interoperable. So we would be looking to balance privacy protection with identity verification, which has to be done, of course, in today's traditional banking system as well.
Thank you very much for this answer. Christine, sorry, you raised your hand. I didn't see it. Please.
Very briefly, Francois. 2 things. One is when we surveyed Europeans, the first concern that they had, in addition to the support to the digital euro, was privacy. Privacy is first and foremost on their mind when we develop the digital euro. In terms of anonymity, there would not be complete anonymity as there is with banknotes, for instance, but there would be a limited level of disclosure, and certainly not at the central bank level.
Okay. Agustin or Ravi, nothing to add. So, if you agree, we will stop there to be on time. May I thank warmly our 4 panelists, because I hope this appreciation was shared with the audience, but it was really a high-level conversation and very useful, including for me. I don't want to sum it up or to conclude, but perhaps 2 or 3 key takeaways. First, about the financial stability issue, you concurred probably to say that it's less cyclical and linked to monetary normalization and more structural and linked, Agustin, to the interconnectedness or the border between DeFi and the classical financial system. Second, regulation is obviously key, and you all agreed about that. We have to regulate differently different animals. We will have this difficult debate about activity-based and entity-based, probably combining both of them, but we need, I strongly stress it, a consistent global regulation. If not, we will not be efficient because it's an international phenomenon. And third, and I would conclude with that, this debate about public versus private money. It's probably slightly philosophical, so to say. Is our debate today about regulating private innovation, which already brings much, and Jay and Ravi, you were very eloquent on this issue, Or do we have, we central banks, to go further and still providing public money in this new tokenized and digital form? As you said, it's public choice. There will be perhaps different answers from different jurisdictions. We will see what are our fellow citizens' expectations. In Europe, Christine was very clear about the fact that there is probably a significant expectation. So it's not only a philosophical issue, it's also a political one, probably in the strongest meaning of the word. This is also what Commissioner McGuinness was referring to in a speech. Having said that, I will stop there, thanking the four of you again very warmly. And now coming to our next roundtable about decentralized finance, challenges and opportunities. It will be moderated by Nathalie Aufauve, whom I call on stage. And Nathalie, as many of you know, is our Director General at the Banque de France for market operations and financial stability. So, the woman of the day. Thank you very much.